You're doing okay. You've got a job, you're paying your bills, maybe you've even got a little something sitting in your super. You're not blowing money on yachts, you're not gambling your paycheck away, you're just living. And somehow, at the end of every month, you're looking at your account wondering where it all went. Here's the thing. The biggest money mistakes young Australians make aren't obvious. They don't feel like mistakes when you're making them. They feel completely normal. They feel like what everyone else is doing. And that's exactly what makes them so expensive. Today, we're going to walk through 5 of them, and I'll warn you now, at least 2 of these are going to feel uncomfortably familiar. Not because you're bad with money, but because nobody actually taught you this stuff, and the system you're operating in was never designed to make this easy for you. Stick with me. Mistake number 1, treating your super like it doesn't exist until you're 50. You're 26, 29, maybe 32. Retirement feels like a different life, a different version of you. So when your employer drops 11% into your superannuation every pay cycle, it barely registers. It's just a number on a pay slip you scroll past. But here's where it gets interesting. That money is compounding right now, every single day. And the decade between your mid-20s and your mid-30s is the most mathematically powerful decade of your entire financial life. Not your 40s, not your 50s, right now. Here's the math. $10,000 sitting in super at age 25, earning a conservative 7% average annual return, becomes roughly $75,000 by age 65. You didn't add another cent. That's just time doing its job. So what's the mistake? 2 things. First, not checking whether your super is actually invested in a high-growth option. By default, most funds put younger members in a balanced or even conservative portfolio. That could be quietly costing you tens of thousands over your working life. Log in. Check your investment option. If you're under 40 and not in high growth, that's worth a conversation. Second, having multiple super accounts. The average Australian has 2.3 super accounts. Every extra account is paying duplicate fees. Consolidate them. It takes 20 minutes and it's one of the highest return per minute tasks you will ever do with your money. Mistake number 2, using Afterpay and Buy Now Pay Later for things that don't hold value. This one's going to sting a little, but I'm not here to lecture. I'm here to show you the real math. BNPL feels different from a credit card. There's no interest, it's just splitting payments. It feels responsible almost, and that's the psychological trap, because Buy Now Pay Later doesn't feel like debt. It feels like a payment plan for your present self funded by your future self. Here's the thing nobody talks about. It's not the individual purchases that hurt you. It's the cumulative BNPL obligations sitting in the background of your cash flow every fortnight. 3 or 4 active BNPL plans at once means a chunk of every single paycheck is already committed before you even open your banking app. And here's where it gets really interesting. The research on BNPL spending shows people consistently spend 20 to 30% more on a purchase when they use a split payment option versus paying up front. Your brain discounts the pain of spending when it's broken into smaller pieces. That's not a personality flaw, that's neuroscience working against your wallet. The rule is simple. BNPL for a necessity you'd buy anyway? Sometimes fine. BNPL for something you wouldn't buy if you had to pay the full price right now, that's a wealth leak dressed up as a payment plan. Mistake number 3, not knowing your actual take-home pay number. This sounds almost too basic to be on the list, but stay with me. Ask most young Australians what they earn, and they'll tell you their annual salary. $60,000, $72,000, $85,000, that number. But that's not the number that buys your groceries. That's not the number that pays your rent. The number that actually runs your life is your fortnightly take-home after tax, after super, after any salary sacrifice. And here's where the mistake lives. When people budget, if they budget at all, they often mentally anchor to their gross salary. They feel like a $70K earner, but after tax, they're taking home closer to $4,700 a month. That gap between the number in your head and the number in your account is where financial plans fall apart. Before you can make any smart money decision, you need one number memorized: your actual monthly take-home. Not your salary, not your hourly rate, the number that hits your account. Everything else, your rent ratio, your savings rate, your investment capacity, gets calculated from that one real number. Mistake number 4, letting the First Home Super Saver Scheme just sit there unclaimed. This one is genuinely frustrating because the Australian government built a real usable wealth tool, and the majority of eligible young Australians either don't know it exists or assume it's too complicated to bother with. Here's how it works. You make voluntary contributions into your super, up to $15,000 per financial year, up to $50,000 total, and those contributions are taxed at only 15% going in. Compare that to your marginal income tax rate, which for most people reading this is either 32 or 39%, including the Medicare levy. That difference is free money, literally a government subsidy on your house deposit savings. When you're ready to buy, you withdraw those contributions plus earnings and you use them for your deposit. The tax saving alone on $50,000 of contributions can be $6,000 to $12,000 depending on your income. That's a week of settlement costs. That's your stamp duty buffered. That's real. The mistake isn't using FHSS wrong. The mistake is not using it at all because it sounds complicated. It isn't. Your super fund or a registered tax agent can walk you through it in one conversation. Mistake number 5, upgrading your lifestyle the moment your income increases. You worked hard for that promotion. You deserve the nicer apartment, right? The newer car, the spontaneous weekend trips because finally, you feel like you've got some breathing room. And this is the most expensive mistake on the entire list because it doesn't feel like a mistake. It feels like reward. It feels like arrival. But here's the mathematical reality. If your income increases by $800 a month and your expenses increase by $750 to match it, you've just worked harder for $50. Your wealth-building capacity barely moved. Your stress levels about money barely moved. You just leveled up your cost of living and convinced yourself it was progress. The people who actually build wealth on ordinary Australian incomes share one habit. When their income goes up, they increase their savings rate before they increase their spending. Not instead of spending more, before. Automate the extra into savings or super or an index fund on the day the pay increase lands, before you feel it, before you adjust to it, before your lifestyle has a chance to expand to consume it. Because here's the thing about lifestyle inflation. You never feel rich from it. You just feel normal at a higher price point. And normal at $60,000 feels exactly as stretched as normal at $45,000 if you scaled everything up proportionally. Here's what all 5 of these mistakes have in common. None of them are about being careless or irresponsible. Every single one of them is a default, a system setting nobody changed, a thing you were never explicitly told to do differently. You're not behind because you failed. You're behind, if you even are, because you were given a complicated game with no rulebook and told to figure it out while working full-time and paying rent that takes half your paycheck. The fact that you're watching this, that's already the shift. Awareness is the gap between the default path and the one you actually choose. You don't need to fix all 5 today. Pick one. The super check takes 20 minutes. The FHSS conversation takes 1 phone call. The take-home number you can write on your phone right now. One move, then another. That's how this actually works.